Good afternoon, ladies and gentlemen. Welcome back to this week weekly market review. We are going into the final week of January already. And as usual, today I have my co-host with me today, Mr. Gerald Wong. How are you, Gerald?
Very good. So we are getting very close to Chinese New Year. Have been busy trying to prepare some of the stuff over the weekend as well. But at the same time, a lot of developments in the stock market. So getting more busy while we are also preparing for the Chinese New Year holidays.
Yes, looking forward to having all the Chinese New Year goodies again. And this week seems to be a busy week. We have the Fed meeting on Wednesday, which we expect no rate cuts. But the rate cut seems to be pushing back towards the May period. And then we also have the non-farm payroll this Friday, as well as some big tech earnings. Will you help us to break down the market for us?
Sure. Okay, so as usual, we will start with the disclaimers. Today's sharing is for information purposes only and should not be taken to be financial advice, even though we are going to be talking about a few stocks that recently reported their results. If you find the session helpful, do leave us a review on Google. And if you have follow-up questions, do join SIAS as a member. We have a monthly Ask SIAS session where you'll be able to discuss with Sunny and myself more in-depth details about what is developing in the market. Okay, so what we saw in the past week is the continued rally in the stock markets. Okay, so S&P 500 continuing to reach another record high, now getting close to the 4,900 levels. Okay, we saw broad gains across different indices, with the Dow Jones up another 0.6%, Nasdaq up another 0.9%. STI saw slight gains of about 0.3%. There was actually quite a strong divergence in the performance amongst different stocks in the STI, which we'll go through very shortly. So the key data point that came out last week was really the economic growth data in the US. We saw that the US GDP grew by 3.3% in the fourth quarter of last year. So that continues to be very strong economic growth. If you look at this chart here, while that has moderated from the 4.9% in the third quarter, actually this 3.3% is still above what we saw for most of 2023. Okay, what is driving this very strong US economy? The consumers are still spending, so there are no signs of a recession, unlike what many people were expecting. Okay, so what actually led to this? What is the result of this? We saw that the US government bond yields actually climbed after the release of the GDP data. So earlier, if you recall, we mentioned that, oh, the US 10-year government bond yield has fallen very sharply to below 4%. In recent weeks, it's actually gone back up to above 4%. Okay, so when I checked yesterday, it was at about 4.15%. Okay, so effectively it has gained since the start of this year as the economy continues to be very strong and investors dial back their expectations of a rate cut in the next 1 or 2 months. Okay, so this is what we see in terms of the expectations of the Fed meeting and what they will decide on the interest rates. Okay, we have a Fed meeting that is coming up on 31st of January this week. And based on current expectations, effectively, most investors are expecting that they will keep the interest rates at between 5.25 to 5.5%. Okay, if you look out to the March meeting, remember, if you have been following our weekly market review, which I hope you have been, what we do see in the past is that investors were starting to expect that the first rate cut will come through in March. But then when I checked it once again yesterday, effectively investors are still expecting that the rate will remain at 5.25 to 5.5% in the March meeting. Okay, this means that the first rate cut would potentially come through in May. So we are still maybe about 4 months away from the first Fed rate cut, based on what we see from the CME Fed Watch tool at this point in time. Okay, so what does this actually mean for the stock market? if I look at some of the top performers in the past week, SIA and Genting were the top performers. Okay, SIA up by 2.8%, Genting Singapore up by 2.5%. Okay, if you recall what was the key news last week, it was really the announcement of the date of the visa-free travel between Singapore and China. So that's going to happen on the 9th of February, just before Chinese New Year. And that actually provide a boost to the tourism-related stocks, including SIA and Genting Singapore. Okay, outside of that, we saw UOB 2.3%. So banks are starting to reverse back some of the losses with the climb up in the 10-year government bond yield. Yangtze Shipbuilding, this is a stock that's consistently done well since the start of the year, up another 1.8%. And last but not least, Mapletree Industrial Trust, which reported their results last week, up by 1.7%. Okay. In terms of the top losers, we saw that the REITs generally saw losses in the past week. So Frasers Logistics and Commercial Trust down by 2.7%, Mapletree Pan Asia Commercial Trust down by 2.8%, and Mapletree Logistics Trust down by 3.1%. Okay, so because of the climb up once again in the 10-year government bond yield, that is affecting investor sentiment towards the REITs because of the concerns around higher financing cost. Okay, so at the same time, we saw quite a number of REITs starting to report their results in the past week. So today, I will share some of the takeaways from the results earnings. I was just doing a poll to see what are some of the names that investors were most interested in. And the names that came up, Mapletree Logistics Trust, Keppel DC REIT, as well as Fraser Centrepoint Trust would be the names that I will go in a bit more detail to discuss this week. Okay, so we start with Mapletree Logistics Trust. I think one of the large cap names in Singapore exposed to the industrial property sector. So what we see here is there was a very strong rebound in November and December last year. This was really driven by the expectations of the rate cut. But if you look at the performance since the start of this year, falling from about $1.74 to $1.56. Okay, so investors are probably wondering why the sharp move down in Mapletree Logistics Trust share price and what we think can potentially happen going forward. Okay, so this is a recap of the earnings that they reported. Distribution per unit of 2.253 cents for the quarter ending 31st December. So that is 1.2% higher than the previous year. Very resilient distributions. So that was really driven by higher contribution that they see from existing properties in Singapore, as well as the contributions from the acquisitions that were made previously in Japan, South Korea, and Australia. Okay, so that's what we see if you look at the gross revenue going up by about 2.1%. Okay, so good sign that their revenue is still inching up. If we look at the net property income, that is rising as well by about 1.5%. I think for Mapletree Logistics Trust, the interesting takeaway that we have is you don't see a very sharp spike in the borrowing cost. It has risen slightly from 35 million to about 37 million, but it is not to the extent that we see for some other REITs. So because the gross revenue has come up, the borrowing cost did not increase very significantly. So as a result, it was still able to report higher distributions for the quarter. Okay, so up by 1.2% compared to the previous year. Okay, if you look at the overall portfolio health, the portfolio occupancy came down slightly, okay, to 95.9% compared to 96.9% in the previous quarter. But because they were still able to enjoy very healthy rental reversions, so up by 3.8% in the quarter. So as a result, we see that the portfolio revenue is still fairly resilient. Plus, on top of it, the various acquisitions that were made that actually enabled the REIT to grow its net property income. Okay, if we were to look at the balance sheet, we see that the gearing remains below 40% at 38.8%, which is just slightly down from 38.9% in the previous quarter. They have a significant portion of their debt that is hedged into fixed rates at 83%. So I believe that has helped them to be able to withstand some of the higher interest rates that we see over the past year. Okay, so that is what we see for Mapletree Logistics Trust. You have got actually a fairly resilient portfolio, not a very sharp spike in the borrowing cost, which has enabled it to grow its distributions. So if you look at the valuation of Mapletree Logistics Trust now at about 1.1 times price to book. Okay, so that is just slightly above the historical average. So we often receive this question, oh, what are some of the REITs that are trading below the book value? If that is one of the metrics that you're looking at, then Mapletree Logistics Trust would probably not fit within your criteria because of the fact that the price to book is actually above 1 times. But on the other hand, if you're to look at it from a dividend yield perspective, current dividend yield of about 5.8%, which is above the historical average of about 5.5%. So still a very decent dividend yield for a large cap REIT that actually has got a resilient portfolio as well as a decent balance sheet. Okay. So that is Mapletree Logistics Trust. Next, I'll move on to talk about Keppel DC REIT, which we also saw very significant volatility in the share price. Okay, again, from late last year, it rebounded from 170 to close to $2.10. Had a sharp correction after they announced some issues with a tenant in China, and then further correcting after they reported their recent results. Okay, so what did we see for the distributions? It was a distribution of 4.332 cents for the second half of 2023. Okay, this is 16% lower compared to the previous year. Okay, so a very stark contrast compared to what we see for Mapletree Logistics Trust. Mapletree Logistics Trust, you saw that the distribution still grew slightly, but for Keppel DC REIT, actually it came down by 16%. Okay, so what is driving this lower distribution? The higher financing costs, okay, that actually led to lower distribution. And they also had some loss allowances for uncollected rental income from the Guangdong data centers, okay? So the Guangdong data centers were assets that they acquired just a few years ago. And I think that is driving concerns by investors around what is the quality of the tenant profile there. And I think that has actually led to some loss allowances being taken for the uncollected rental income. Okay, so this is a breakdown. What you see here is that the gross revenue came down slightly, okay? But if you were to look at the property expenses, okay, that actually increased very significantly from 12 million in the second half of last year to 23 million in the second half of 2023, okay? So number one, that actually led to the fall that we see in the net property income. Then on top of that, you have an increase in the finance costs. Okay, so earlier we saw that for Mapletree Logistics Trust, it was a slight increase, but for Keppel DC REIT from 18 million to 26 million in the second half of 2023. Okay, so with that, the distributable income actually came down by 18.5%. Okay, so we see that the higher property expenses, some of it was also driven by the loss allowance that we mentioned earlier, that was for uncollected rental income from the Guangdong data centers. Okay, so what is this really about? We saw that effectively there was uncollected rental and coupon income of about 5.5 months. So that as a whole impacted the 2023 distribution per unit by about 0.649 cents. Okay, so effectively what the company is now doing is that by the end of December 2023, the tenant has settled part of the sums in arrears, just a small amount of about 0.1 million Sing dollars. And what Keppel DC REIT is doing is to work with the tenant on the recovery roadmap. Okay, so they have also mentioned that they reserve the rights in respect of acquisition of Guangdong DC3. Okay, so if you're wondering how big is this exposure for Keppel DC REIT, if you look at the breakdown of their assets now, Singapore still remains the bulk of the assets at about 55%. Thereafter, you have got Australia at about 8.6%, and a number of assets in Europe, Ireland, Netherlands, Germany, and the UK. And then China is about 7.5% of its total investment properties. So I believe this is the part that is now causing concern amongst investors. Okay. We also saw the higher cost of borrowing for Keppel DC REIT earlier. What we see here is that it's an average aggregate leverage of about 37.4%, so increasing by about 20 basis points compared to the previous quarter. The average cost of debt has also gone up to about 3.6% in the fourth quarter versus 3.3% for the whole of 2023. Okay, so this increase in the average cost of debt actually led to the higher financing costs that we saw earlier. Okay, so if you look at the expected dividend yield of Keppel DC REIT now at about 5.7%, which is higher than the historical average, and also quite similar to what we see for Mapletree Logistics Trust. But investors are probably concerned that the distributions may fall much more than expected, like what we have seen in the second half of 2023. So that probably explains the sell-off that we see for Keppel DC REIT. Okay, if we look at it from a price-to-book valuation, now at about 1.3 times price-to-book, higher than what we see for Mapletree Logistics Trust. So again, if price-to-book valuation is one of your considerations, this is the latest valuation that we see for Keppel DC REIT. Okay, last but not least, Fraser Centrepoint Trust, one of the REITs that has been a bit more resilient compared to what we saw for Mapletree Logistics Trust and Keppel DC REIT, hovering between the 220 and 230 levels over the past few months. Okay, so the big news for FCT last week is that they've announced an acquisition of the additional 24.5% stake in Next for 523 million, and that will raise its effective stake in Next to 50% on completion. Okay, so together with that, they actually announced a private placement at 218 per share that will raise about 200 million to partially fund this acquisition. Okay, so this is a summary of the key details about the transaction. So acquire additional 24.5% stake, will raise the effective stake to 50%. This will value the whole property at about 2.1 billion. And for the acquisition of the 24.5% stake, that will amount to about 523 million Singapore dollars. Okay, I believe most of us who are based in Singapore would not be not familiar with Next. Okay, if you live around Serangoon or somewhere along the Circle Line of Northeast Line, you'll probably be aware of the crowds that are at this shopping mall. Okay, so I wouldn't go into detail around what the asset actually is, but what is worth noting is that the committed occupancy of Next was actually 100% at 31st December 2023. So I think that's really a reflection of the crowds that we see at the mall, such that the occupancy is at 100%. Okay, so in terms of the expected impact to the DPU from the transaction, this will be expected to boost the DPU by about 0.4%. And together with some of the divestments that FCT had previously announced around Changi City Point and Hectare REIT, that will effectively boost the distributions by about 1.5%. With the fundraising that has been announced of about 200 million. The aggregate leverage of FCT is expected to go down to about 37.8% from 39.3% currently. Okay. So if I were to look at the valuation of FCT, earlier we saw that the price to book valuation of Mapletree Logistics Trust and Keppel DC REIT is above 1x. But what we see for FCT is that while the share price has been resilient, the price to book is actually still below 1x at about 0.95x. Okay, so that in a nutshell is the major acquisition that FCT announced that actually impacted its share price in the past week. So having gone through a number of REITs that reported, we have another busy week that is coming up. This morning, we just saw the MAS monetary policy statement where they have kept the monetary policy unchanged and lowered the expectations of what the headline inflation is expected to be in 2024. But apart from that, we have a number of REITs that are reporting this week as well. That includes Mapletree Pan Asia Commercial Trust, Frasers Logistics and Commercial Trust, all the Keppel-related REITs like Keppel REIT, Keppel Infrastructure Trust, and Keppel Pacific Oak US REIT. Okay, and then we have got Ascendus REIT and Lendlease REIT also reporting this week. Outside of the REITs, we also have the large cap blue chip names in Singapore, Keppel Corp, SGX reporting this week. And we also have the US mega tech stocks, Microsoft, Alphabet, Apple, Meta, and Amazon reporting their earnings. And on the macro front, we have the US Fed meeting that is coming up this Wednesday. So a very packed calendar that we have for this week. And I'm sure in the weekly market review next week, there will be a lot that we'll be able to go through as well. So with that, I hand over to Sunny, who will share with us what the technical indicators are looking at this point in time.
Let me share my screen first. Okay. Okay, thank you, Gerald, for the breakdown of what happened last week on the markets, especially on the results of the REITs. So now I will give you a roundup of how the indices perform. So let's start with the STI first. Let's go for a recap on the STI. At the beginning of the year, in the first 2 weeks or so, we forecast that the STI would be coming down towards this level. That means testing the 200 days moving average, and then subsequently it was capped at 200 days moving average. Now, looking forward at the indicators of the STI index, I'm seeing that the MACD indicator is now is negative, definitely. So that means that there's negative momentum in STI index right now. However, you can see that the MACD line and the signal lines are both trajectory to a sideways direction. That means that more or less the negative momentum may be subsiding or neutralized. So it's telling us that the STI market might likely be going sideways or maybe slightly negative due to the negative reading on the MACD indicator. On the RSI, the latest reading is at 52, so it is still very close to the neutral mark of the 50-point mark. So that means that STI is not having any kind of a direction as of now. So STI is likely going to be slightly negative or neutral going forward in the next few weeks towards the Chinese New Year period. So where is STI likely to hit? I think the next support level that we could be looking at would be the low that we see somewhere on 21st December. That is the day where we saw the first rise in the big rally during the December period on the STI index, where we rise up about 5%. So now it's coming back down, and this support level could be a key level to watch out for should the STI pull back further due to the indicators reading. Okay, so do look out for the STI to come down slightly further, and then that level will be around the 3,094 points level or the 3,100 points level. That would becomes the next support for the STI index, which we are about 60 to 70 points away right now. Okay, next, let's look at the US indices, the Dow Jones Index. So we are at all-time high right now on the US indices. So a lot of investors are asking, a lot of investors are afraid that we are now going, if we buy now into the US indices, we'll be buying at an all-time high period. I read through some of the statistics in the US index where how the index perform when we are at the all-time high, when we reach an all-time high throughout the past 20 years period. And the statistics seems to point to us that every time a market reach an all-time high, if the returns for 200 days later would usually be positive at 83% probability. So even if you're looking at a long-term view to hold the index for a 1 year period, it is likely that even if you buy now, based on what history has suggested, you will still be in a positive mark right now. However, I would not advise that as a trader. I would want to have some pullback to get some buffer in before I get into the major US indices as well. So if you look at the Dow Jones Index now, we are now at 38,109 points. So this is a very elevated level. There is no historical level that we can reference to, but I would want to point out maybe there may be some seasonality similarity. If you look at the early periods of 2023, you can see that Dow Jones Index sort of have a little bit of a rally and then it pull back in March again before the rally starts to go again. So for now, with the Dow Jones Index at an elevated level, with the RSI close to the 70-point overbought mark and the MACD showing a negative reading right now, I don't think the current setup is right to go for a long position, and we would need to see some pullback or some consolidation before getting into the Dow Jones Index. So the first reference point that I would be having on the Dow Jones Index would definitely be the high that we saw in early part of 2022. That would be around the 36,900 points level, or I will just round it off to 37,000 level before considering getting back into the Dow Jones Index. Another reference point that you can take would also be the blue color line here, which is the 50 days exponential moving average at 36,800 points. So these are the two key points that I'm looking at, because the 50 days moving average might be catching up to the 36,900 points level then, and then we could have some confluence to form a firmer support level for the Dow Jones Index. Next, let's move to the S&P 500. Same thing, all-time high right now. And if you look at what happened in the early part of last year, the first few months, we see that the S&P 500 actually had a small rally from the January to the February period. And then we had a pullback, quite a significant pullback in the March period where it went back to where it started off in 2023. So this pattern may sort of repeat itself again. So we also saw that the S&P 500 rising very steeply up in the January period, and maybe it will continue or trend sideways for the month of February, and then towards March, we may see a pullback or a consolidation level. Why is this so? Because the RSI has already crossed the 70-point mark, which is the overbought mark. And if you look at what happened historically in December, in July, as well as in June, once it hits this above the 70-point mark, you will see that the index starts to consolidate or starts to have a bit of a pullback. Okay, so these are the signs that we are looking out for. And now that the RSI is above 70, I hope that the pullback, there could be some pullback or consolidation happening, so that it's more healthy for the index to push higher for later on in the year. Same thing for the MACD. We do have a slight positive reading right now, so there's still a positive momentum in the S&P 500 index. However, we are at the elevated level, so I cannot say for sure how far this rally would go. Definitely, I don't have the confidence to go in right now. I'm waiting for a pullback to the levels. I would say, let me look at the previous few years. The previous high that we saw was in the early part of January at the 4,818 points level. That was the high in early of 2022. That will be my first reference point. Just slightly below that, we have the green line or the black line that you see here, the Bollinger Band basis, which is a 20 days moving average around the 4,780 points level. And a significant pullback will happen when it starts to test the 50 days moving average in blue, which is 4,689 points. So rounding it off about 4,700 points, that is where I see a pullback might happen to test, and then that could be an interesting support level to analyze further when we reach that point to see where will the S&P 500 go from there. Okay, lastly, the Nasdaq Composite Index. Let's look at the seasonality pattern again. We have a very big rally in January last year, and that could also, what I say, that could also repeat for this year. And if we look at some of the key levels, the Nasdaq is not at an all-time high yet. The previous all-time high that we saw was actually at the end of 2021, okay, at the level of 16,212 points. So the Nasdaq Composite Index, I would say, having not tested the all-time high, would probably have a higher chance of extending the rally upwards compared to the S&P 500 and the Dow Jones Index. So if this rally were to repeat itself, the early part of last year, then towards the February and March period, the same seasonality pattern might occur again, and we could have a pullback. And if a pullback happens, the next level I'm looking at will be the 15,150 points level over here, which was the high that we saw quite a few years ago. So I'm just going to put my chart to the weekly chart to pull out that point for you. And that is around the period that we saw in the late 2021 period. Okay, so this is the first support that we are looking at for the Nasdaq Composite Index, which was the previous high that was tested in 2021. So going back to the the daily chart, the other significant levels that you should watch out for, of course, is the 20 days moving average at 15,100 points. And then we also have the 50 days moving average at 14,695 points. So it can be a quite a range of pullback that we are looking at. But definitely, if you look at the Nasdaq Composite Index now, way higher above 20 days moving average, which is at a very elevated level right now. So the MACD indicator is positive right now, so still positive momentum, but that positive momentum seems to be subsiding last Friday. So we will see whether this subsiding of the positive momentum is likely to continue. And the RSI has breached above the 70-point mark last week, and last Friday it pulled back to the 69-point level, so it's still at an elevated level. So I think this definitely suggests that there might be some signs of a market getting into the overbought region right now, and we need to have a pullback or a consolidation level happening before getting back on firmer ground into most of the major indices worldwide. Okay, and that is all I have for this week update. We hope you do learn something from this. And if you do want to stay tuned to our latest update, do consider to subscribe to our video. And then next week on Monday, we'll see you again on our weekly market review.